What is acquisition accounting and how can you leverage it? In this episode, you will learn the meaning of acquisition accounting and the benefits associated with it. Stay tuned. Acquisition accounting is a set of formal guidelines explaining how assets, liabilities, goodwill, and non-controlling interest of an acquired firm must be reported by the buyer. This implies that the acquiring company must stick to the guideline provided during the agreement to avoid breaching the deal. Whenever a firm is purchased by another, there are some formal guidelines that must be followed to record this transaction. These guidelines are carefully planned out based on the acquisition method of accounting. When your business buys another company, your company is expected to report certain categories of the purchase on a consolidated statement. Under acquisition accounting, you are expected to include the following factors in the report: non-controlling interest, goodwill, assets, and liabilities. Several unique rules that surround the reporting of each of these factors must be covered by acquisition accounting. In line with acquisition accounting, you are expected to report the purchased company's fair market value between the net tangible and intangible assets documented on your balance sheet. Any differences between the two are regarded as goodwill. So how does acquisition accounting work? The acquisition accounting approach demands everything to be measured at fair market value, the amount a third party would pay on the open market during the acquisition period. This also comprises the date that the buyer took control of the target company. Other factors to report about include the following. 1. Tangible assets and liabilities. These are physical assets like machinery, land, and buildings. 2. Intangible assets and liabilities. They include non-physical assets like patents, trademarks, brand recognition, copyrights, and goodwill. 3. Non-controlling interest. This is also referred to as minority interest. In non-controlling interest, a shareholder can own less than 50% of outstanding shares and still have no control over decisions. 4. Consideration paid to the seller. The buyer will have several options to pay. Most of these options include cash, stock, or a contingent earnout. Calculations must be made for any future payment obligations. 5. Goodwill. After accomplishing the entire steps, the buyer must then calculate if there is any goodwill. Goodwill is documented in a situation when the purchase price is greater than the sum of the fair value of all identifiable tangible and intangible assets purchased during the acquisition. When you carefully deploy acquisition accounting while purchasing the shares of another company, you can carefully merge your existing company with the new one and accomplish your goals of doing so. Focus on making success a priority by taking advantage of acquisition accounting. Thank you for staying put to the end. We hope that you have learned something about acquisition accounting. See you in the next episode.